Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic financial statements. In this question, you will mainly prepare the statement of financial performance and the statement of financial position, also known as the income statement and the balance sheet for a PTE limited company. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings, which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. The following balances were extracted from the books of Heidi PTE Limited on 31st of July 2023. So here you can see list of balances provided for various asset, expense, equity, liability items, and then we are given some additional information here, and then we are required to prepare the statement of financial performance for the year ended 31 July 2023 and the statement of financial position as at 31 July 2023. So we will first start by working out all the additional information that we have been given. All right, so let's start with the first one. As at 31 July 2023, salaries of $900 for the month of July 2023 were still outstanding. So what do we understand by outstanding? Outstanding is referring to salary expense, which we have incurred, but we still have not paid it with cash. So we have used the labor from our staff in our business operations, but we still have not paid them yet. So here's an expense which has been incurred already, but we still have not paid for it using cash. So therefore, it is a present obligation for the business, and therefore it is classified as a current liability, and we're calling it salaries payable. Okay, so we have got salaries payable of $900. Okay, so within the statement of financial performance, you will report this in the other expense section, where you will show the total amount for salaries expense to be the amount that is given here. As you can see, 28,980, which is referring to mainly the salaries paid, and then an additional $900 for salary expense incurred but not yet paid, which gives us a total salaries expense of $29,880. So this is the amount which you will report in the other expense section in the statement of financial performance. But in the statement of financial position, which is your balance sheet, you will show your current liability, and that current liability is the salaries payable of $900. All right. Now, let's move to the next additional information which we have got. Rental expense included $1,200, which has been paid for 3 months rental ending 30 September 2023. So we understand that we have got $1,200 in rental expense, and this $1,200 is valid for 3 months. So just by using that statement, we can simply calculate the monthly rental expense, which is $1,200 divided by 3, and that is $400. Now, we understand we are preparing the financial statements at 31 July 2023. And at 31 July 2023, based on the information given to us, we understand that rent has been paid until the end of 30 September 2023. So when we are at this point in time, which is 31 July 2023, we can understand that rent has been prepaid for the 2 months ahead, starting the next financial year, which are the months of August and September, right? So given that the monthly rent is $400, which we have already calculated, and we understand that we have paid 2 months rent in advance, which are the months of August and September, the total amount for prepaid rent is therefore $400 multiplied by 2, which is $800. And because this rent is prepaid, it is referring to us paying cash in advance for an obligation that the other party has to fulfill for us, which means we have some kind of economic benefit attached to it, right? And therefore, it perfectly fits within the criteria of a current asset. So when you prepare the statement of financial position, within the current assets section, you will show the amount for prepaid rent, and that is $800. All right. Now, when you report the rental expense amount in the statement of financial performance in the other expense section, you will report 4,550 minus 800. So where did we get this 4,550 from? So check the list of balances that are given to us, and you will see that we have got rental expense of 4,550 here, which includes all the amount that we have already paid for cash for the purpose of rent. But we do understand the 2 months have been paid in advance, so which we are deducting from this total amount, and therefore the actual rental expense amount that we have incurred for the financial year ending 31 July 2023, which are the 12 months that we're mainly looking into, is $3,750. Okay, so 800 are referring to the 2 months ahead, which is a prepaid rent to be shown as a current asset. All right, and the 4,550 is being reduced by 800 to give us 3,750, which is an expense that we have incurred for the 12 months ending 31 July 2023. So this is excluding the $800 for the future 2 months, right? So when you prepare the statement of financial performance, you will show 3,750 as the rental expense, which has actually been incurred. And this is mainly because of the accounting theory accrual theory, which talks about only recording expenses that we have incurred, not necessarily everything that has been paid for with cash. All right. Now let's look into the third one. Commission income receivable was $180. So obviously we understand we have earned some kind of income, but we have not yet received it in cash, which means we are expecting economic benefits in the next financial year. Therefore, we can confidently classify this as a current asset, which is therefore shown in the statement of financial position or the balance sheet. Okay. But in the statement of financial performance, when you report your other income, we show the total commission income that we have actually earned for the year. So we had originally $280 given in the list of balances here, which is referring to the commission income that we have actually received in cash. Okay. And now we expect to receive an additional $180 in the next financial year, but this is actually an income which we have earned at 31 July 2023, right? So therefore, the total commission income earned that we report in the income statement is $280 plus $180, which is $460, okay? And we need to report it under other income, not as part of our regular income, because regular income really refers to the sales revenue of the business, which comes from regular business operations, okay? All right. Now, when you prepare the balance sheet, we have already discussed that you show commission income receivable as a current asset. Now let's move to the next information we have got. $4,000 of the bank loan is due on 31 January 2024. Okay. So we understand that we are preparing the financial statements at 31 July 2023, right? Okay. Now, if you check the list of balances that have been given, we can see bank loan here, which is $20,000. And therefore, obviously, it is on the credit column because it's a loan. It is an obligation. It is a liability, right? But based on the additional information, $4,000 is due for payment at Jan 2024. So given that today we are here at 31 July 2023, from 31 July 2023 until the end of 31 Jan 2024, we have got 6 months ahead. So we know 6 months from now, we have to pay $4,000 of bank loan. This is what we can confidently classify as a current liability, because current liability refers to the present obligation that a business has, okay? Which means, and this present obligation has to be taken care of within the next 12 months. So given that we already know some kind of bank loan has to be paid after 6 months, we therefore have to show it in the statement of financial position as a current liability. So we are aware that we have this repayment coming ahead, okay? And when you show the non-current liability section in the statement of financial position, you will show the bank loan amount that is the non-current portion to the $16,000. Why? Because this $16,000 is not due for repayment in the next 12 months. It is due for repayment after the next 12 months. Therefore, it is not a present obligation, but an obligation after a year. Therefore, this falls within the definition of a non-current liability, okay? So $4,000 goes as a current liability amount, and then $16,000 go as a non-current liability amount, both obviously in the statement of financial position or the balance sheet. Okay, so now let's move to the third one. A debt of $350 owed by a customer was found to be irrecoverable. The company decided to write this amount off. So when we think of an irrecoverable debt, it is referring to a credit sales which we made in the past with a customer, and that customer was supposed to pay us back later. But now that customer has confirmed that they're unable to pay that amount for a past sale, therefore we have no other choice but to write it off as irrecoverable. And therefore this is an expense for the business because you have some kind of loss which is going to have an impact on your profit, right? So irrecoverable debt, which is also known as bad debts of $350. So this is what we report in the income statement, which is a statement of financial performance, okay? And because it's an expense, you will show it in the other expenses section. And then we have got the statement of financial position of the balance sheet, where when you report the gross amount for the current gross amount for the trade receivables in the current assets section, you will show it by removing the irrecoverable debt of $350 from the original trade receivables amount balance of $17,100 that is given to us here. So where is the original amount given here? So you can see trade receivables of $17,100, okay? But this is all the credit customers of the business with whom we have made credit transactions, right? But one of them has confirmed that he's unable to pay, and that amount is $350, which we are just simply taking away. So that leaves us with a gross amount for trade receivables of $16,750, and this is to be reported as your current asset in the statement of financial position, also known as the balance sheet. Okay, now let's move to the next additional information. Our review of the trade receivables listing showed that 4% of the trade receivables may be irrecoverable. Okay, so what do we have here? So we understand previously we just calculated the gross amount of trade receivables after removing the amount which has been confirmed that we cannot collect it. And that leaves us with $16,750 of trade receivables. Now, we have a policy within our business where we want to create some kind of allowance for impairment of trade receivables. So it is a contingency measure, and this is mainly based on the prudence concept, where we do not want to overstate our assets and understate our expenses. We want to make sure that we are careful because obviously we have sold some items on credit, right? But maybe not all these customers can pay this. And this is something we understand based on our experience in the business, okay? So 4% is the amount that we want to set aside as a contingency measure, mainly using the prudence theory, which we mentioned not to overstate assets and not to understate expenses, okay? So 4% of $16,750 would be $670 that we want to set aside as a possible allowance for impairment of trade receivables, okay? And if you check the balance that is given here, the list of balance, allowance for impairment of trade receivables of $470, this is referring to the balance which we had at the end of previous financial year, which would be at 31 July 2022. So compared to the end of the previous financial year, this financial year, it has increased to $670. And what is the amount of increase in this allowance? It's the difference between 670 and 470, which is $200. So whenever there's an increase in allowance for impairment, does that not indicate an excess risk that is coming into the business? Because now there is a chance that more of the credit customers are unable to pay. So obviously, as a business, we may suffer some losses, right? So therefore, we can say that we have some kind of expense, which is an impairment loss on trade receivables, and that is $200, obviously to be reported in the other expense section in your statement of financial performance or the income statement. Then in the balance sheet, when we show the current assets section, we will show the net trade receivables, which is 16,080. And the way we will show it is by first including the gross amount of 16,750, and then we will show less allowance for impairment. And this allowance for impairment is the amount that is 670 derived at the end of this year, which is 4% of 16,750, and that was 670. So this is what we have to report in the balance sheet, these two numbers specifically to get the total marks. Okay. All right. So now let's move to additional information number 5. So depreciation policy. Motor vehicles are to be depreciated at 20% per annum on the net book value. First of all, how do we calculate the net book value? The net book value is simply the difference between the cost and the accumulated depreciation. The accumulated depreciation of any asset refers to the total depreciation expense for all the years since the asset was first brought in the business. Okay, so the cost of these motor vehicles is 55,300, and the accumulated depreciation is 11,060. So we find the net book value to be 44,240, and now what we do is calculate the depreciation by multiplying the depreciation rate of 20% with 44,240 net book value, which is also the reducing balance method. And that gives us a depreciation of 8,848 for motor vehicles, which we will show in the other expense. And in the balance sheet or the statement of financial position, you will show the total accumulated depreciation for motor vehicle, and that would be the 11,060 from previous year, plus an additional 8,848 for the 12 months in this year, and that would be a total of 19,908. All right. So next we have got fixtures and fittings, which are to be depreciated equally over 10 years without providing for any scrap value. So what do we understand by scrap value? So scrap value refers to, is there any amount that we may be able to sell the asset for after the useful life is over? In this case, it is saying that there is no scrap value. So it's just probably pretty much disposed, like there's no use of it. So you can't sell it or get any money. So it would be fully depreciated, okay? So if you want to find the depreciation whenever a scrap value is involved, given that you know the cost and the useful life, you simply take the difference between the cost and the scrap value, which gives us the depreciable portion, and then we divide that amount by the useful life. So the cost for fixtures and fittings is given here at 4,800, and the accumulated depreciation is given here at 960. So that means, accumulated depreciation is given here at 960, but it is not used here because we are doing the straight line method, which has a different formula, right? So 4,800 minus the scrap value of 0 divided by 10 years gives us $480 per year. But the total accumulated depreciation would be that 960 we just talked about, plus the 480 for this year ending 31 July 2023, which gives us altogether 1,440, this amount, which we will report in the non-current assets section when we prepare the statement of financial position. Okay. Now let's go to additional information number 6. Part of the inventory bought at $1,400 has a net realizable value of only $1,160 on 31 July 2023. So obviously we can see the value of inventory has gone down, and a business may experience this when we have stock that has been there in the warehouse for a long time and maybe we're unable to sell it, so it would lose its value or demand in the marketplace, so therefore there's this drop in price. So that is what we classify as an impairment loss in inventory, which is simply the difference between $1,400 and $1,160, which is $240. And this is an expense for the business because it is a loss, right? And all losses are an expense for the business. And then when you report the inventory total as part of your current asset, and the reason these are current assets is because you can obviously sell them and get money in the future. So the total amount for inventory is going to be 6,900, which is given here in the list, which included that portion that we need to remove. So that would be to minus 240. So that would leave us $6,660 as the inventory value. Now let's go to point number 7. Our dividend at 5 cents per share was declared on 22 July 2023, and this is to be paid on 22 October 2023. Okay, so 5 cents per share. How many shares do we have? So here at the beginning, you will see we have got 25,000 shares in our equity, right? And 5 cents per share is simply 0.05 multiplied by 25,000, which gives us $1,250 as the dividend that we have to pay. Now, who do we pay the dividends to? We pay to our shareholders, right? Okay, so shareholders are the investors of the business. So this amount is declared at 22 July 2023. So when we prepare the financial statements at 31 July 2023, we still have not paid it. So therefore, this is an obligation, a present obligation. So we will show this amount as a current liability. And then in your equity, you report the retained earnings. So the retained earnings will need to be reduced by this amount of dividend eventually. So if you want to find the retained earnings at 31 July 2023, you will take the opening amount, which we are given here, 24,020, and then you will add any profit for the year. If you have got a loss, you will subtract it instead of adding profit. And then lastly, you will subtract dividend, okay? So at the moment, we don't know the profit or loss. So that's what we will figure out by doing the statement of financial performance, all right? All right, so let's look into the statement of financial performance. So we start with the sales revenue, and that is what we can find within the list, which is $125,100. So sales revenue of $125,100 minus the sales returns, which is $535, and that gives us net sales revenue of $124,565. Then we subtract the cost of goods sold, which is also something we get from the list, and that is $52,480. So net sales revenue minus cost of goods sold of $52,480 gives us $72,085, which is what we refer to as the gross profit. That is the profit derived from the regular operations of the business. Then we add the other income portion, and usually it's discount received and commission income, or it could be any one of these. In this case, we have both of them, as we can see. So you will find the discount received here, the second last line in the list of balances, and that is $540. And then the commission income is $460. If you recall from our workings, we had an original amount of $280 given in the list, which is referring to the commission income that we have already received in cash. And based on the additional information, we understand that we expect $180 more, and therefore altogether the total commission income earned is $460, okay? And then the discount received we have already talked about, second last line, $540. So these two are to be added to the gross profit as your other income. Then we subtract all our other expenses. And why do we say it's an other expense? That has to mean before that there has to be an expense. Which is the expense item before these other expenses? That would be the cost of goods sold, which is an expense in itself, all right? Relevant to the regular operations of the business. So that is a direct expense. But the other expenses are those that we have as part of running our business operations, which could be anything that is indirectly related or directly related. So starting with the salaries expense that we have got, and that is $29,880. If you recall from the very first working which we have done today, we had salaries expense that we have already paid for using cash, which we got from the list to be $28,980. And then based on the additional information, we understand $900 was still payable. So that gives us a total salaries expense of $29,880. Then we have got rental expense that we have actually incurred for this financial year ending 31 July 2023, and that was $3,750 after removing the rents for the 2 months, if you recall. that was $800 subtracted from $4,550. And those 2 months of $800 are prepaid rent, which we will show in the balance sheet. Then you've got general expense, which you'll find in the list of balances here, 10,890. So we have just included that. Then you've got discount allowed of 830. Now, why is discount allowed an expense? Discount allowed refers to discount that we offer to our credit customers if they are able to make the payment quicker than they have promised. It's like, hey, John, I know you want to pay after 30 days. That was the original agreement. But now I do need some cash in the business. So therefore, if you're able to pay it today, I'll give you a 10% discount. So we are willing to take that loss so we can get some extra cash injection for our business. And that loss is what we classify as a discount allowed, okay? So discount allowed is 830. And then we have impairment loss on trade receivables, which we found in our workings of $200. Don't forget the irrecoverable debts of $350. Then we had 2 assets which we depreciated. So we are very specific here. Depreciation of motor vehicles, which is 8,848. And then you show depreciation of fixtures, which is 480. Then don't forget the impairment loss on inventory, which we had to write down to the net realizable value. And that is $240. So what we do now is find the total of all these other expenses. And that is 55,468. which is what we deduct from the total of gross profit and other income, okay? So that gives us profit for the year of $17,617. All right, now that is sorted, let's move to the statement of financial position. So the statement of financial position is based mainly on the accounting equation, which is total assets must equal the total equity plus liabilities. So we start with the assets, and mainly we'll first show the non-current assets. So non-current assets must be shown using this 3-column format, where we first show the cost of the specific asset, followed by the accumulated depreciation, which is the total depreciation for that asset since the day it was purchased and brought into the business, which gives us the net book value once we deduct accumulated depreciation from the cost. So we have 2 assets. So motor vehicles at cost is given in the list. You will see it's 55,300. The accumulated depreciation is 19,908, which we derived in our workings. That gives us a net book value of 35,392. Then you've got fixtures and fittings with an original cost of 4,800. The accumulated depreciation is 1,440, which was 960 plus 480. And that gives us a net book value of 3,360, which is again simply the difference between the cost and the accumulated depreciation. So what we want to do is we want to find the total net book value for all these non-current assets, and rather not show the total for cost or accumulated depreciation, because the net book value is the economic benefit that is actually available for consumption for the business to help the business generate more revenue, right? So we are mainly interested in the total for net book value, which is simply 35,392 plus 3,360, and that is 38,752. Then we have got all the current assets, starting with the gross amount of trade receivables, which we had a thorough discussion about, and this is 16,750. Then we subtract allowance for impairment on trade receivables, which is 670, which we calculated at 4% of 16,750. That gives us a net amount for trade receivables to be 16,080. Then we show the revised amount of inventory after accounting for that impairment loss, and that is 660. Then we show the cash at bank, which is the very last list item here, 56,045. We have got prepaid rent for 2 months, which are the months of August and September, and that is $800. Then you've got commission income receivable, and that was $180. So we find the total of all the current assets, which would be 69,765. That is added to the total of non-current assets to give us total assets of $118,517. Okay. Now we show the equity and liability section, starting with the equity. So first of all, we are showing the share capital, 25,000 shares, which is the very first list of balance given, which is the very first balance given in the list, and that is $50,000. And then we need to report our ending retained earnings at 31 July 2023. And here you can see I have shown 40,387. But how do we get this though? If you remember, at the end of our workings, we had a discussion. So I'm going to bring that discussion back here again, but I'll write it in red. So we start with the opening balance of retained earnings, which is 24,020, the second balance given in the list, as you can see. And then we said we add profit or subtract loss. Based on the statement of financial performance, we can clearly see that we have made a profit of $17,617, right? So we add that here. And then lastly, we subtract the dividends. And the dividend that we know was 1250, right? Based on our workings, the last one. So when you do this calculation, you get an ending retained earnings of 40,387. What do we understand by retained earnings? Retained earnings refers to profits that are available for reinvestment as we move to the next financial year. So when you report the retained earnings within your equity, you are reporting it with the share capital to show the investors, like, look, this is the total amount that we can invest in our business operations moving to the next financial year, okay? So 40,387 in retained earnings added to the share capital of 50K gives us a total of 90,387, right? And that is the total equity. Then we report the non-current liabilities, mainly the bank loan, which we had a thorough discussion about as well, where the total amount for bank loan was 20K, but the non-current portion is 16,000, which is due after the next 12 months. And the current portion was 4,000, which was due within the next 6 months of preparing these financial statements, and therefore becomes a present obligation. So we show non-current liabilities for bank loan of $16,000. And in the current liabilities section, you show the bank loan again of $4,000 to show the amount which is repayment, which is going to be repaid in the next 6 months. Then we have got other current liabilities from the list given here. So we have got trade payables of 5,980. You can see here, I am going to highlight it. And then you've got salaries payable, which we have already found in the additional information. That was 900. And then we have dividends payable of 1,250. So we add all this total for current liabilities, and that is $12,130. So how do we now finish this balance sheet? So we find the total equity and liabilities, which is simply the total current liabilities of 12,130 added to the total non-current liabilities of 16,000 added to the total equity of 90,387, which gives us 118,517 in total equity and liabilities, which must match the total of assets to ensure that the accounting equation is balanced. And that is the case here. And that's exactly how you score 20 out of 20, all right, in the main exam. Okay, so that's all for today's lesson. I believe you found value in this content. Make sure to drop a like, subscribe to this channel, comment on what videos you would like me to make, and check out the link in the description to join our coaching program, which is exclusively online, running for the entire year until the day of your exam, and it's going to prep you to get the best results. With that being said, I'll conclude today's lesson, and I'll see you in the next one.